everyone, welcome to Principles of Accounts class. For this lesson, we would want to achieve the following objectives. 1. Outline the concepts that guides the accounting process. 2. Identify various types of business organization. 3. Identify the main financial statements prepared by various business organizations. 4. Define the following terms: assets, liabilities, and capital. 5. Identify the accounting equation. 6. Use the accounting equation to calculate assets, liabilities, and capital. Materials needed for these lessons are your notebooks, calculator, pen and pencil, and a ruler. Based on our objectives, we want to start off by looking at accounting concepts. If you play any form of sports or even watch the games being played, you will notice that there are some rules or guidelines which governs the playing of the games. In other words, these rules outline how the games should be played. Some of these principles could be applied to accounting, whereas accounting concepts are rules which lay down how the activities of a business are recorded. By activities, we are referring to the day-to-day transactions of the business. The basic accounting concepts are: 1. Accruals concept, also called the matching concepts. 2. Prudence or the conservatism concept. 3. Consistency. 4. Separate entity or business entity concept. 5. Going concern concept. 6. Money measurement concept. The accrual concepts or matching concept states that net profit is the difference between revenues and expenses incurred in generating that revenue. In other words, revenues are only to be recorded when they are earned and not when they are received, and expenses are to be recorded when they incurred and not when they are paid. The prudence concept ensures that assets and income are not too high and liabilities and expenses are not too low. This is because it implies that accountants should take the figures that understate rather than overstates. As the name suggests, consistency, meaning that one should stick to a particular method for an accounting period. In other words, you cannot use one method this week and next week you want to use a different method. There must be some level of consistency. This method simply indicates that you cannot mix business with pleasure. Thus, the affairs of the business must be treated separate from the affairs of its owner or owners. Going concern concept is very important because it indicates the basis upon which financial statements will be prepared. Therefore, financial statements are prepared assuming that the business can and will continue in the foreseeable future. Accounting is only concerned with those activities in the business that have a monetary value and can be measured, hence the money measurement concepts. Accounting will never tell you about management problems, problems with the labor force, or competitions in the market. It is only concerned with items that can be measured and have a monetary value that most people will agree to. There are several forms of business organization for which financial statements are prepared, some of which include sole traders, partnerships, limited liability companies, cooperatives, and non-profit organizations. Now, students, there are two types of business organization operating out there. We have the profit-making organizations, non-profit makers. In accounting, financial statements are prepared for both organizations, that is, the profit-making organizations and the non-profit making organizations. The financial statements that are prepared for these organizations are 1. The trading and profit and loss account, which gears towards calculating whether the business makes a profit or a loss. 2. A sheet, which is also called a statement of financial position. 3. An income and expenditure account. And 4. A cash flow statement. Now, students, let's examine the picture and clearly define assets, liabilities, and capital. Based on the picture presented, asset is what you own. Clearly then, we can say that assets are the resources owned by the business, while liabilities is what you owed. Therefore, liabilities are money owed for resources supplied to the business, and capital or resources supplied to the business by its owners. There are two types of assets, fixed and current assets. Fixed assets are those assets that are brought to be used in the business and not primarily for resale, while current assets are those assets that can be easily turned or categorized into two categories: current liabilities and long-term liabilities. Current liabilities are those liabilities that have to be paid within a year, while long-term liabilities are those liabilities that are due beyond a year. Now, students, let's examine the accounting equation. The accounting equation states that assets is equal to capital plus liabilities. Therefore, if you want to calculate assets, you will add capital and liabilities. Now, if you want to find capital, you take away liabilities from assets. And if you want to calculate liabilities, you take away capital from assets. Example 1. Calculate assets when capital amounts to $5,000 and liabilities $2,000. Using the accounting equation, which states that assets is equal to capital plus liability. Then we're going to look to the right of our sheet, and on our sheet we want to calculate assets. So what we're going to do for activity 1, example 1, we are going to add the $5,000, which is capital, plus the $2,000 for liabilities, and that is going to give us an asset of $7,000. Example 2, we are to calculate capital if assets is $25,000 and liabilities is $3,500. So the accounting equation tells us that asset is equal to capital plus liabilities. Now we want to find capital. So what we do is we're going to take away liabilities from assets. So therefore, we're going to take away $3,500 from $25,000. That will give us a capital of $21,500. Now, activity 3, example 3, states that we are to calculate asset liabilities if asset is $120,000 and capital is $55,000. To calculate this, be reminded of the accounting equation, which tells us that asset is equal to capital plus liabilities. Now we want to find liabilities. Therefore, we are going to take away capital from assets. In this case, we will be taking away $55,000 from $120,000. That will give us a liability of $65,000. Okay, students, this completes our lesson. Here are the answers for activity 1. Give yourself a tick if your answers were correct. And if you did not get them correct, please go over the information and work the activity again. Remember, accounting is practice. I hope you have learned something from this lesson. See you again in my next class.